Now on the markets is Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business, Chief Economist at Wisdom Tree. Jeremy, Professor, it's good to see you. You said that we won't see a rotation into small stocks and value stocks until it becomes clear the Fed's going to cut, and that the CPI, you said this before it came out, could be a game changer. That's exactly what happened. You saw what happened with the Russell yesterday. Now, what is this? 3 steps forward, 2 steps back? What did the PPI say to you?
Well, I think it's 4 steps forward and maybe 1 step back. There's a few components here that do go into the PCE, and it's going to take a little while to suss that out. But I think that the CPI was a game changer. And yeah, I mean, it was last Friday for Scott Wapner closing bell that exactly what I said. And I think the Fed should definitely cut. I mean, not only was it great inflation news on the CPI, which is far more important than the PPI, but let's look at jobless claims. Now, jobless claims were good this week, but don't forget they reported the week of July 4th, which, is always distorted. I'm really looking at it next week because we've been on an upward trend, not only on claims, we've been on an upward trend on the unemployment rate. When we hit 4.1%, we hit the so-called Psalm rule, which says that if the 3-month moving average goes up 0.5%, which it did on the last labor report, the probability of a recession is very high. Now, I'm not calling for a recession, but I'm saying that is on the Fed's radar. So I'm looking at that. I think he's teeing up a cut. I'm just hoping that he'll cut fast enough that he won't go too slow on the way down, the way we know he went far too slow on the way up. So my concern is not that he's going to, cut too much, but he might cut too slowly. But the data will tell us what the judgment is.
So what does all that likely mean for real estate going forward from here? So inflation came in cooler than expected. And part of the reason for that is we're seeing some parts of the economy are slowing down and things are not as good as they look like from just looking at things like the stock market, which is roaring ahead. It's hitting new all-time highs virtually every day. The jobs data shows that some areas of the economy are doing really well. The overall number for jobs looks really good. But when you dig deep into some of the data points, you can see that there's quite a lot of government-funded jobs. And when you look at other parts of the economy, retail, professional services, and manufacturing, those jobs are not doing so well. And so the job creation, while good, is helping to sustain the real estate market. But what it's showing is that there's a slowing down of the economy. So what we've effectively got is a lot of people celebrating that inflation is cooling, and it's cooling because jobs are weakening in parts of the economy. And the betting now is that the federal funds rate, which is currently at 5.5%, the current betting is that either in July or in September, when the Fed next meets, that the betting has gone really high now, that we're up to, in September, up to 90% of participants that participate to this survey feel that we're going to get a rate cut from the current rate of about 5.5 down to around a 5 to 5.25. What that should signal is that things like mortgage rates will come down, but it also signals that car loans may come down, credit card loans may come down, loans may come down. So affordability could actually start to look more positive going towards the back end of the year. So that is where all the excitement is right now, is that while the job numbers are looking weak in parts of the economy, that actually could mean that while unemployment is ticking up and it's showing some signs of a recession looming, the prospects of a recession are still treated as really low. and the interest in the speculative markets is actually that the lowering of interest rates potentially over the next 3 to 6 months, we could see a couple of cuts even going out into 2025, that's going to stimulate the economy in various areas, and in particular the housing market. So that's where it's really positive.